Thank you, Tom and Kate. If you thought our last topic, which was private equity, was a broad canvas to paint on, then the title of this panel, which is the Global Finance Roundtable, is even a greater playground for mischief. And I have three great people representing slightly different skill sets in the financial world. Cliff Sosin to my left, who runs a friendly hedge fund, a very thoughtful one. Meredith Whitney, who is a great credit analyst and a broader participant in the financial sector. And Bob Diamond, my friend, banker, equity, fixed income, you name it. He's hired half of the great people on Wall Street. I'm on the board at Morgan Stanley, where Bob started, and the people who Bob hired are still there and are still loyal and thankful to Bob. So because of that, and because we're both wearing the green sweater, I'm going to start with you, Bob, with the question, so how scary is it out there? What should we think about where we are at this time, and maybe also picking up a little bit of Barry's theme? Is it a failure of our political leaders? Why do we all feel so uncomfortable?
Well, it's a good question. There's no one simple answer, but I think one of the things that has been surprising to people who are investors over the last weeks, months, I'm sure you've seen it, is the incredible lack of liquidity when there are big moves. People talk about quantitative trading, ETFs, this, that, and the other thing. And I think it's a tale of two stories, but we sit here and we think about the repercussions of the financial crisis that started in 2007 or 2008. I'm just going to think of a couple of them: Basel III, buffer upon buffer of capital, European Union directives on compensation, ring fencing of banks in the UK, balkanization, Volcker rule, the Fed deciding that banks are not allowed to have commodities businesses. And we wonder why commodities are more volatile when we have, it's kind of like a duh. You think the liquidity is down. On the other hand, which I think is equally important, is that this is creating a phenomenal entrepreneurial opportunity for smaller firms to enter into these businesses and not be blocked by the big global banks who were creating flow monsters that really garnered a lot of the volume. And I think we're in an adjustment process. We invested in Atlas Merchant Capital. We invested in a standalone repo business a couple of months ago. Who would have ever thought that we'd have a standalone business in US Treasury repo that wouldn't be part of Goldman Sachs or Barclays or Deutsche or JP Morgan? So we're beginning to see the positives of the entrepreneurial efforts, but it's very, very early days and we're in a transition. So we're going to see much higher volatility and much more severe moves. The other thing that strikes me in terms of leadership was, I was asked last week, just before the Fed made their decision, and I don't want to pick on the Fed because I think they made a small error here, but I think it's indicative. But I was asked the day before the decision not to raise rates what I thought the decision was, and I thought that they would raise. I was wrong. But the real importance was, why did I think they would raise? And I think there were two reasons. One, Chair Yellen was very, very clear on it. And I think the FOMC, which does incredible work in this area around data, showed that an unemployment rate that was close to 10% during the financial crisis, we're close to full employment. So the data suggests. But to me, the bigger reason, I said, was I think the market reaction will be better if they raise rates, where everyone's saying the markets are going to fall apart if they raise rates. Well, another eighth of a point or quarter of a point in the US where rates are zero, it's really going to impact interest rates in Nigeria? I don't think so. And I think we're in a situation where the FOMC and the chair have signaled for 2 or 3 years that as we approach this, and it's not a question of are we going to raise rates, it's a question of when. And then to delay it again and to say, no, we're not ready when it's completely priced in the market creates more confusion. So I think that was another piece of why we're seeing this reaction in the markets.
Meredith, what do you think? Let's stick with the Fed rate decision. should they have raised rates, and will they raise rates in December, or will it be a perpetual, there'll always be, some country having a problem and we never raise rates?
The smartest thing I think that was ever said to me in financials was you have to ultimately have faith in what is ultimately a faith-based system, which is the financial markets. And the mistake that the Fed made by not raising rates was losing some credibility. And I think that people, and this is a theme that's been discussed quite a bit today, people feel like there's something wrong. They feel uncertain, but they can't pinpoint what exactly it is. And we know for the last 6 years, part of the reason why the private equity world has gotten so incredibly wealthier has been mispriced assets, right? You had just mispriced cost of capital, and they smartly seized on assets and opportunity and were able to ride assets up a great deal. So, but the asset prices are mispriced. You knew that junk bond access to prices were mispriced, and the market's feeling that too. And I think another part is that liquidity is a miss. So you see so much capital being created by the government worldwide, and a lack of assets that used to be there. So you think about the simplicity of just the sheer scale of the mortgage market, an asset class that can't be replicated on a basis of scale by any other asset class. So you see money, like almost a scrum of money into private equity funds, into junk bonds, into municipal bonds, into sovereign debt. And the markets actually aren't large enough to absorb those. So the swings then end up underpricing risk. And I think everybody knows this, so no one really knows what the real cost of any asset is. That's a very disturbing issue. I think there's also a very uncomfortable balance of power whereby the central bankers of the world are expected to not only be responsible for their dual mandate, which is inflation and employment, but also curing cancer. And I'm being, they're responsible for the wage gap, income inequality, poverty, so many issues that have been thrown at them because they're seen as basically the only government, the only grown-ups in DC. And so that brings to another issue, something that Joe Quinlan brought up earlier in terms of leadership, right? So there's an imbalance of leadership. So the central bankers have had too much power. 6 years later, the leaders of the financial industry have been beaten so silly they can't see straight. So the imbalance of power of the regulators actually having more power, or at least feeling like they have more power than the financial leaders, it creates a really gummed up situation that needs to be broken at some point. And I think, and then, aside from which, so much distrust and frustration with government, yet the lowest voter participation rate in the history of this country. So finally, to get to Barry's point, which is we'll reach a point of resilience when the system has to break, but I hope we don't get to the point where we lose so much faith because the Fed then has sort of given up and refuses to act. That you don't have sort of what, another sort of political revolution, which would be the fourth in this country.
We'll come back to this one, but first I want to bring Cliff in. I think of you as a real fundamental analyst, a stock picker bottoms up. Do you care at all about the macro stuff other than the feed into your discount formula? What's the interaction for you? Can you still find great companies even if we're in the middle of a huge asset inflation?
There's a variety of ways to think about that. We certainly, if you're looking at an auto dealership and you're trying to measure the profitability of that auto dealership, and you're using a starting point the last couple of years, then having a general notion as to whether or not the number of cars sold over the last several years is representative of the number that will be sold on average over the next couple of decades is an important thing. So in that sense, you care a bit about where you are. As to whether the Fed raises rates now or next year, and I don't think we're going to look back in 20 years and think, it was because it was 25 bips in December. You see, that's what changed the whole outlook of the world. And so in that sense, in terms of price volatility, we try to allow that to work for us. So we're looking for businesses we understand we can get for a lot less than they're worth, and to the extent prices are volatile, that works in our favor. The famous example is the unstable business partner who comes in every day, sometimes happy, sometimes sad, and sometimes offers you some of his share. And to the extent that you can keep your head, if over time you take his whole share of the business, and that is in essence our business model. The last piece you said though about very expensive assets, I wouldn't necessarily say that assets are alarmingly expensive. I think they're roughly average, although there certainly are pockets that are expensive. And there's always a distribution, and our job is easier if assets are on average or cheap, and it is more difficult if assets are on average or more expensive. But we're nowhere near the extremes in terms of prices in many asset classes that we can't find interesting things to look at.
So
He's
Bob,
talking equities.
right.
That's
so
correct.
Right.
I was about to broaden it out for both of you. Picture yourselves as you are asset allocators. Everyone wants some pragmatic advice. This is an expensive island. The stock market's gyrating like mad. I don't want to put money into fixed income because I know eventually they're going to raise rates and I'm going to get killed on bond prices. Commodities, there's no liquidity. Where do you put your money other than parking it in cash?
I think this is the perfect environment, but this fits my bias to put it into businesses. And the whole underpinning of Atlas Merchant Capital is we're investing where we have influence, are active, not active in a public sense, but active in a pull up your sleeves, take part in be part of operating excellence. So I think this is an environment where businesses are great. Unsurprisingly, we believe that the single best investment opportunity is in sub-Saharan Africa if one has a medium to longer term view. Ashish talked about it earlier. The underpinnings are far more than a resource center, which 10, 15, 20 years ago it was about resources. It's now about agriculture. Over half of the arable land left in the world today is in sub-Saharan Africa, and the biggest sector of the economy in Nigeria is agriculture. It's not oil and gas. It's the unbelievable growth in discretionary income. For the first time, individuals, consumers are moving into the middle class, are moving into cities, and they actually have discretion in terms of spending money. The demographics are very powerful. Now, the world is ugly a little bit. Ugly is the wrong word. The world is a little bit scary, to use your word. Sub-Saharan Africa is not going to be immune to the commodity cycle. It is going to have an impact. It's not going to be immune to a slowdown in a correction in China. I think it's a correction, not more than that. But the underpinnings of the economy, somewhere like Mozambique, might go from 7 or 8% growth to 5 or 6% growth. But I think in the world we're in today, that kind of underpinning of 5 or 6% growth against headwinds is pretty impressive.
I remember you saying before that actually it's a real advantage that people find Africa as a whole incredibly scary, or one of the 50-odd countries is in complete revolution, because it allows you to focus on the 9 or 10, which are actually pearls, but are painted with the same broad brush. Do you still see that?
Yeah, our goal is to create the leading bank in sub-Saharan Africa, yet we've targeted 14 countries, not 46, 14 countries where we see the right political environment, the right economic growth, the right governance, democracy. So there's a lot of pieces to it. 10 years from today, might we change that 14 to a larger number? Possibly. But over the period of building this institution, it's 14 key markets for us. And we're in 7 of them. We have a lot of work still to do, but we're in 7 of the 14 that we want to be in.
Cliff, you want to jump in?
One of the recurring themes has been this idea that there's somehow heightened uncertainty. I think what maybe there was in years past was some sort of perhaps perception of less than the normal level of uncertainty. I think there's about a normal level of uncertainty, and I don't think that level of uncertainty has changed very much in 50 to 100 years. I mean, it was probably higher during World War II. You could have lost. It was definitely higher in the Civil War, right? Like, but if you think about the span of history, like, the future is uncertain. What we're talking about is prices in the market seem to have been up and down a little bit more of late, and that to me, I don't think that has any particularly important meaning.
How long are the gates on your fund?
I think there's a tremendous amount of uncertainty. I think that
I think there's tons. I just don't think it's changed.
Watch the Republican primary debate. It's a complete. I was raised better than to repeat what I would say about it, but it's a train wreck.
No, go ahead. We're friends.
So yes, we are. But there's ample uncertainty in the markets. That said, I'm a U.S. gal. I think that the U.S. has so much liquidity, an understandable, accounting system, which is one of the big issues we have with China, a common language, it's a workable and scalable system. That said, you take advantage of the lack of liquidity because that's where you can make real money. So rather than get involved in sort of a frenetic trading environment, pick themes and long-term themes that we understand. Uber was mentioned, ride sharing, what that does to the entire auto industry, the auto dealer industry that you mentioned. There's so many long-term themes that we can grab hold of, and there's so many, there's so much optionality in terms of how we can play them within the U.S. market that give us scale and liquidity. That pick your price, and I am really, both scared and also optimistic in terms of the markets. I think I can get what I want at the prices that I want, so I just put basically pretty good price points in and wait. And I've gotten surprising access to names that I wouldn't think I would have access to otherwise if it weren't for volatility. I think what happened in August was a little bit misleading because a lot of the prices that printed you couldn't even touch. So, but it sort of gave you a mindset of have a plan and look at all the information that's out there. And one thing that can be said, I think there's a disturbing imbalance between regulators and companies and talking about how leaders are scared. But what's happening is the regulators are a little bit on pause, and what they're saying to companies, and this is so disturbing, we don't know what to tell you in terms of how to operate, but we'll tell you when you're doing something wrong. We'll tell you when we see it. It's like, thanks, like that just breeds paralysis. But what that means is that they don't have anybody under their target in a major way to enact, and I'm just talking about the financial services industry, to say we're going after this absolutely next. So the disruption that causes, this brings back to something Bob said, there's an opportunity for smaller players to really take significant market share away from some of the more scared players. And ultimately, as the system wanted to get the big banks getting smaller, they wanted the small banks to get larger. And now, this is a 20-day discussion, what's happening in the shadow banking industry and how those participants have come and really changed the face of the financial markets is, I think, what's disruptive right now.
So Bob, I want to stick with this issue for a second about regulation. A couple of days ago at a UBS management conference, it was reported Sergio Armotti, the CEO at UBS, told his 300 top managers, some of our friends among them, that, you know what, it's okay to make a mistake. Don't break the law, don't bring compliance down, you know what the environment is, but if the rule is you can't make a human mistake, you'll never make any money. It's bad for the institution, it's bad for society. Now think of what Randy was talking about the entire ethos of Silicon Valley and the importance of making mistakes, learning from them, pivoting. You obviously lived in that environment. You now have some of the advantages of being on the outside. Have we swung too far? Do you think it will stop? I mean, we should all care about the large institutions that hold our funds and intermediate commerce, et cetera. Can't all go to lending club.
You know, when we started Barclays Capital in 1997, it was a small, broken UK sterling-based broker-dealer with no global position. And we grew that business over a dozen years to be one of the bulge bracket investment banks. There was no way to do that without making mistakes. There was no way to do that without taking risks. We were competing with Goldman Sachs and Morgan Stanley and Deutsche Bank and UBS. And how do you possibly come from behind to the top without taking risks? You can't, point one. And when I'm asked to mentor kids, one of the most important principles I give is be willing to take risks, be willing to fail, pick yourself up and try again. Now, transform now to your question on banks. I think it is an issue, Tommy, but I think it's for the biggest banks. It's for the SIFIs and G-SIFIs. And it's not the regulators, the political leaders. The political leaders in the US, the UK, and Europe still do not believe that too big to fail has been eradicated. And they're afraid of a mistake. And if another mistake happens on a political leader's watch, they're going to lose their position. And so we have buffer upon buffer of capital. We have separation of risks and deposits. We're told banks can't be in the commodities business. I think for the next 10, 15, or 20 years, we're going to see that at the top level. And we've come through 30 years of increasing size, globalization, interconnectedness, all of which formed very large institutions. And we'll still have some large institutions. But I think their ability to fail, their ability to take risk, the continued separation of the deposit business from the risk business is going to create a lot of change in that industry. I don't think it's the same for the smaller institutions. That's what's so exciting. Because what the political leaders are afraid of is too big to fail systemic risk. If the smaller firms fail, they're not creating systemic risk. So I think we're going to see a mixture. I think there's going to be a lot of great entrepreneurial opportunity in financial services, opportunity we haven't seen for 30 years. On the other hand, I think the largest institutions are going to be semi-paralyzed for quite a while.
Meredith, what do you think? Also, comment a bit on peer-to-peer or credit marketplaces now that I brought up a Kleiner Perkins investment in lending.
I'd be happy to. But just to say, since we're amongst friends, a disturbing story that I heard from a CEO of a major bank. They were down in D.C. with Obama and saying, okay, so we've been beaten, we're scarred. What can we do? What can we do to move the system forward? What can we do to help? And how can we actually take a leadership position? And Obama turned to one of his aides and said, what do the polls say? And the polls said, people still hate banks, and it's one of the leading issues that polls. Okay, so we're not going to do anything. I'll lay off you, but I can't keep everybody else laying off you. If it polls and gets you elected to beat up on the banks, it works, and that's what people are doing. And so that's why it plays. And so actually, when you ask people, do you hate the banks? Yes. Do you hate your bank? No, not really, right?
That's what people say about their divorce lawyer and their spouse's divorce lawyer, too.
I wouldn't know, thankfully. But it's...
How would you know?
I don't know, Marit, cover your ears.
So at any rate, I think to Bob's point, it still polls really well to beat up. I would say that individuals on the flip side are kind of sick of hating, right? They're sick of hating the institutions, the banks. Interesting about Lending Club and of the ilk. So I started on Wall Street in 92, 93, and I worked in specialty finance, which for my boss, who sent me on these glamour trips, right, I would take a rental car around the Houston Loop and visit used car dealerships to find out who was going to be the most aggressive and whatnot. So with all that, so this is when banks and especially finance companies were separated before '99. The biggest problem that made or break companies was funding. And I had been through a major credit crisis in the form of 1998 when not just dozens, hundreds of companies went out of business because they couldn't access funding. Securitization put them into business, and the 3-month breakdown in the securitization market took their businesses away. So again, funding had always been the issue. 18 months ago, something fascinating happened and really gave me pause, which is the entire market flipped over. It was no longer a funding problem. Heck, there was more funding than you could ever imagine. And in fact, one company said there's a 9-to-1 ratio of money that wants to invest in people's loans, meaning people didn't want to borrow as much as people wanted to lend them money. And this all came outside of the banking industry. So you had funds being set up, private equity, hedge funds, just throwing money at this industry. So enter you mentioned Lending Club, but there are plenty of peers, Prosper and Cabbage and On Deck and so many companies that, by the way, this is not Lending Club, it is at scale, that think it's so easy to be a finance company, and because they've got better analytics, they're going to actually break through any type of credit cycle that's ever existed before. Okay, anyway, so at any rate, what I think is really interesting about sort of this new paradigm is now it's just about adoption, right? So it's not about funding anymore, it's about engagement. And so because you have this big upside down situation, what is it going to take to get consumers to engage? And so it comes down to this issue with technology where it's sort of, it's too big to be small, but it's too small to be big, right? The big banks are paralyzed from regulators, so they're not getting involved as much as they should. And in fact, strangely, they're funding the companies that actually are taking their customers because they can't put those loans on balance sheet. But they have the customers, and companies like Lending Club are actually literally cannibalizing their customer base. So I think we're at this point in time in consumer finance that's fascinating and importantly, and at the end of the day, I'm a tireless romantic, maybe as a Brown grad, so total romantic.
Not another.
I got to plug Brown again.
Can we have some more RISD people, please?
But companies like Lending Club and companies, and actually the legacy companies, have an ability, if they take a leadership position, to work with the regulators. And remember, you never make anybody in government look bad, right? So work with the regulators, take a leadership position, and actually you can, I believe, create trust back with the consumers and engage the consumers again. So really moving the industry forward. And after 6-7 years, that's what it will take to get the economy engaged and the economy moving forward. And it sounds really sappy, but I think it's possible.
I'm going to take an extra 30 seconds. That's all that separates you from booze, for a really quick down the panel answer to the following question, which you sort of raised. Obama gets a lot of heat. This is not a political side question, but he gets a lot of heat for his leadership in general. But if you look at the numbers, you're a numbers guy. I'm going to start with you, Cliff. Employment, 5.2%, growth, pretty good compared to the rest of the world. If you only looked at the numbers and nothing else, and not the pundits, and you said, has this president done a good job managing the economy on the basis that all of us as CEOs are based on, is what are your results? I don't care about the color in particular. What do you think? Yes or no?
Managing the economy for businesses or for consumers?
No. Just plain, how am I doing? Ed Koch used to ask.
So two things.
Not a long answer.
Sure.
Quick one.
Two things happened. One was the recovery was slower than historical recoveries. You could argue that might have been politically impacted. You could also argue it wasn't. The second thing is that profit margins have increased, and one of the observations we've made over time is that, contrary to the desires of many policymakers, heightened regulation tends to add complexity and barriers to entry, which reduce competition and transfer wealth from consumers to corporates. And so the problem with macroeconomics is there's a tremendous narrative bias, but if you follow that narrative, you might think that Obama's arguably anti-business stance had the impact of slowing growth, increasing unemployment, and increasing corporate profits all at the same time.
Okay. Meredith?
Categorically, he is not. And I will make another DC example. Fannie Mae looked like it had great numbers until it went out of business. And I'm not saying the U.S. economy is going out of business, but there's a massaging to numbers that has gone on that doesn't represent the real story and the underlying economy. And
Just like we think about China, of course.
right, go to Main Street. He hasn't ruined it, but I don't think he's improved it, and he's certainly widened the wealth gap in the country.
Bob?
Tommy, 2 points that I think are critically important to look at. Home ownership mortgages. Land of the free, home of the brave. Over 90% of the mortgages in this country don't come from banks, they come from the government. This is the most socialist home ownership, more than the Nordic region. The second is taxes. United States companies have a higher tax rate than any other country in the world, including Japan. We could take that rate down to 20% easily if we just simply did away with the exemptions. We have companies like General Electric who pay 0 taxes. They're doing nothing illegal. They just have all these exemptions based on years and years. So take corporate taxes down to 15%. Stop fooling around about whether capital's held overseas, whether we're doing inversion or non-inversion. And any exemption to that 15 or 20% tax has to go back through Congress. It's really easy to do. It's not complex.
Will you all join me in thanking the panel?